Hello and welcome. My name is Simon French and I'm Chief Economist at Panmure Gordon. Today we're going to take a look at the very conflicting amount of macro data that is coming out of the global economy at the moment, and in particular the divergent picture being presented from three parts of the economy, specifically the home sales data, retail sales data, and the data coming out of equity markets that suggest a very aggressive V-shaped recovery in activity. And contrast that to what we're seeing in terms of employment, industrial orders, and consumer confidence, which suggest a very continued depressed level, much more uncertainty over the outlook going forward. The first thing to say is that I don't think that there is a contradiction in this data. I think the data is giving a fair representation of the relative strengths of those parts of the economy. But I think the underlying explanations give us a better feel for which of those two baskets of data are going to win out in the tug of war of the economic recovery. First thing to note on the positive side is that retail sales have been boosted largely by pent-up demand that was constrained during lockdown, but also diverted demand, where a number of households still have their consumption of foreign travel, of entertainment, of leisure events constrained by social distancing, and therefore have converted that spending into other areas of the economy where retail sales has benefited. The other thing to note around the strength of the real estate market and residential real estate is that, of course, with lockdown and potentially increased home working, the utility value for individuals of their home has risen. And therefore, even though credit conditions are largely unchanged, there's been a little bit of a reduction in the overall 30-year mortgage rate in the United States and similar reductions in the long rate around the world. Actually, it has been that change in utility value that has really driven interest back into that market. But contrasting that picture and the cue that equity markets have taken from quantitative easing, which has totaled almost $5 trillion since the start of the year, contrast that with industrial orders, consumer confidence at a much more depressed level, and indeed the employment outlook with more than 15 million Americans fewer in employment than at the start of the year. And I think it is unfortunately those parts of the economy that give us the better long-term signal of the pace of the recovery, as extreme support for the jobs market in the form of checks sent out to households or furlough payments start to be pulled back. We'll start to get the real flavour of how much rotation needs to happen in the economy to service new patterns of demand, but also the balance sheet headwind that may come about in the corporate sector from the additional leverage that has been taken on by corporates to get through this period. So I don't think the commentators out there that are pointing to V-shaped recoveries in real estate, residential risk assets are misrepresenting the picture. There certainly has happened in those parts of the market, but the explanation around diverted demand, additional utility value, are perhaps one-off factors that are less sustainable than the employment picture, which remains very, very cautious. And the big challenge actually going forward is whether policymakers, businesses, households can restore levels of confidence to see consumption come back and consumer confidence come back to try and limit the job losses.